In this week's video, we'll review the latest charts to help us answer the question, how much further could stocks fall? In the main segments of this week's video, we'll be covering these 3 bullet points. Why stocks are still vulnerable, how far hypothetically could they fall, and what's the status of the signals and rally attempt off the 80-80-80 low. Friday session, June 10th, NASDAQ down 3.5%, S&P almost 3%, Russell 2.7%, Dow 2.7%. From a weight of the evidence perspective, there's really not a lot to get excited about. From a potentially bullish perspective, the VIX was fairly tame during Friday's session. It was up 6.86%. However, the VIX was fairly tame here in the rearview mirror. You can see this was the session high. It closed here, and the S&P 500 continued to fall. So this is a small piece relative to the weight of the evidence, but it is relevant. Another development helping us keep an open mind about a wide range of outcomes, including bullish outcomes, can make an argument here that we're retesting this closing low here, and we have yet to exceed the intraday low from May 20th. Also got this gap down here. It's possible the market will go back and try to fill that gap. It's also possible that we could have a gap and go situation similar to the COVID peak. Here's the first low here. You get a gap down here. Price intraday undercut this low. We rallied into the close in this case. So you can make an argument this looks pretty good over here relative to this. And then, of course, we gap down the next day. Point of showing this and this, both are relevant, but we don't want to be making decisions that ignore the weight of the evidence. This is a very small part of the weight of the evidence, and not necessarily a showstopper. Now let's jump right into bullet point number 1. This portion of the video is being recorded around 11:40 a.m. Eastern Time on Friday, June 10th. This chart is as of the close on June 9th. Just 6 sessions ago, we were still in the process of retesting all of these levels on your screen. In fact, 6 sessions ago, we closed above all 6 of those levels. On Thursday, we closed below all 6 of those levels. What once acted as support, what once acted as support, what once acted as support may now act as resistance. It's the same chart during the session on June 10th. Now, we've talked about 4170 before, including this tweet here from June 5th. You can see the market came right back up to this level here, and thus far has failed in an attempt to retake it. This is Bitcoin to the US dollar during the session on June 10th. As we'll cover elsewhere in the video, the concept of an air pocket or less resistance or an easier area to fall applies to the stock market as well. S&P 1500, new highs minus new lows percent. Moral of the story on all of these charts is we're really not at an oversold level. This is where we are as of June 9th. This is the oversold look at the COVID low, Christmas Eve low, February 2016 low, and the low in October of 2011. So these types of looks, the type of a look that says we've been much more oversold in the past, says the market could fall further, and during the course of the video, we'll try to get some idea of how much further from a probability perspective. Same concepts here. S&P 500 in this case, we've been much more oversold looking back to 2010. S&P 500 greater than their 50-day moving average. This is where we are on June 9th. This is the lowest level here in October of 2008. Same exact concepts going back to 2002. S&P 500 stocks greater than their 200-day moving average. We did get setup signals, but we never, or thus far, have not received a breath thrust type look. Here's your thrust look off of the COVID low. Here's the weak move that we've had recently. This chart is as of June 9th. Has an oversold look to it. Could it fall further? Yes, it could relative to history. There's even a wider gap here NYSE greater than their 200-day exponential moving average. Recent reading up here, you can see where lows occurred in the past, going all the way back to the 1987 crash. NASDAQ 100 greater than their 200-day. Dow stocks greater than their 150-day. You can see we got almost down to the zero level here at the COVID low. The last close that we had on June 9th was way up at 33%. None of this predicts anything. It just tells us relative to history, we've been more oversold in the past. This is where we are in the present day. Similar level here to Q4 of 2008. Haven't really seen anything on the recent rally attempt that was able to break trend relative to this look here at the COVID low. I believe we covered this chart for the first time back on May 13th. This was the version that we covered on May 20th. You can see the NASDAQ on May 20th had come all the way back to this level here. This is November of 2020. There's also a gap up here in September of 2020 in the same general area. And the thought process is, since the NASDAQ is the leader on the downside, it's within the realm of possibility that other indices will follow suit and backtrack to similar levels. Notice we use the term possibility. All of this speaks to probabilities. None of it is a forecast. The breakdown look in SPY that we covered previously using this chart came back up, retested this general area in here, and now we're back below during Friday's session on June 10th, this gap here. The longer we stay below that gap, the more relevant it becomes. Hypothetically, if the NYSE composite from intraday on June 10th came down to the same general area in here that the NASDAQ did earlier in this year, from June 10th intraday, that would represent an additional drop of 12.28%, hypothetically. This was the equal weight chart that we covered back on May 20th, said this was a concerning look with the moving averages tight and rolling over, consolidation for roughly a year from April to April. The same chart as of June 10th, we had a bearish breakdown here, what appears to be a retest of these levels up in this area here. And during the session on June 10th, we're back below this level here from February of this year. Value line arithmetic index. This is the chart we covered back on May 20th. Here's the same index on June 9th. From this line here, which price is already below it as of the close on June 9th, but in the same general vicinity, if we drop down to that area where the NASDAQ dropped earlier this year, roughly a 24% loss. VLE is a good way to think of how far could the average stock hypothetically fall from this dotted line here. And the geometric index would be the median drop, is a good way to think of it. Intraday on the 17th, the answer to that question would be hypothetically 17.38%. If you went down to this area here in early November, or back to this gap area here for the NASDAQ in September of 2020. One of the concerns here is on a relative basis, hypothetically, a drop from this point here to this point here would be a lot easier. There's a lot less support relative to the drop that we've already experienced. So as we go down the staircase here, there's a lot of areas of potential support along the way relative to what happens potentially in here. Similar concepts, this would be the largest of the large caps. From intraday on June 10th down to this level here would be approximately 13%. Remember, we covered this from numerous perspectives back on May 20th, and a lot of the back of the envelope calculations said we could have further to fall. The value line indices are based on approximately 1,700 stocks. Here's 1,500, so roughly 3 times broader than the S&P 500 from May 27th up here, and that's where we were just 2 trading sessions ago. That would represent roughly a 19% additional loss. not forecasting anything here. As risk managers, we need to understand what is the potential downside. Here's the inverse head and shoulders pattern that we covered in a previous video. Here's your shoulder, here's your head, here's the other shoulder, here's your breakout. Now this looks like a successful retest as of June 10th intraday, retaking an upward sloping 50-day in blue. Similar concepts here, Staples XLP relative to XLK. It's the tiered look here. This is your easier white space that we filled here. This is harder white space in here, and then it would get even harder to get into this area here. We rallied back to these levels here, came to a downward sloping 50-day in blue, and for the most part, it looks like we're failing. You can see it on the chart of the Dow, the weekly chart here. What once acted as support may now act as resistance. This is intraday in the morning, approximately 10 a.m. on June 10th. Dow daily, June 10th, intraday. Here's a massive gap. This is the same general area where the NASDAQ backtracked to in terms of the calendar earlier this year. This was the rollover look on the probabilistic 3 steps for a trend change look that we covered back on Friday, May 13th. Another inverse head and shoulders like pattern here, Dow relative to the NASDAQ for now. The breakout's holding. We've got a full bore bullish look for the most part over here, favoring the Dow over the NASDAQ. Similar concepts. This was the 3-step probabilistic trend change chart that we covered on May 13th. This is the S&P 500 intraday on June 10th as of 10:22 a.m. Relative to the last trade at 39.07 up here, the intraday price, if, hypothetically, we were to fall back to the same general area where the NASDAQ backtracked to earlier this year, hypothetically, that would represent an additional drop relative to the intraday levels on June 10th of 14.82%. One of many possible outcomes. The S&P 500, like many charts, made a run back to a downward sloping 50-day moving average in blue, and thus far has been unable to even get back into the rolling over moving average cluster. Covered this same chart back on May 27th. This number here at the time was 18.23%. Here's a big air pocket potentially on the S&P 600 small cap chart. Similar concepts with a breakdown over here for Apple. Looks like a retest. What once acted as support may now act as resistance. The good news for Apple is there is some potential support, quite a bit of it, over here relative to, let's say, a chart like this. This is Apple here, weekly intraday on June 10th. This is the 23-week moving average. You can see when price goes below it and it rolls over, typically bad things happen. Again, not a prediction, just speaks to odds. Very, very similar concepts with Microsoft and a big head and shoulders look in momentum. This is MTUM. This would be your left shoulder. This would be your head. This would be your right shoulder. And this is your neckline here. We went up and retested the neckline this week, and thus far it appears that we're failing. There is potential support in this area here. Trade the chart in front of us, not making any predictions about what's going to happen next. We're assessing the odds relative to the chart in front of us today. XLF intraday, June 10th, hypothetically, if you backtrack to the bottom of this massive gap here back in November of 2020, that's a drop, hypothetically, an additional drop of 24.7%. The growth versus value concepts. During the session on June 10th, Amazon all the way back to levels seen in April of 2020. Like Apple, Amazon does have some potential support relatively close by. Potential support. This was the chart or the concept that prompted this bullet point here from the April 15th video on the bottom of your screen. We looked at this chart previously. This one is dated June 10th intraday, and this was the one we covered a few weeks ago to say that this look here was relatively rare and concerning. Remember, in last week's video, we covered a new special situation model, the market pivot rally attempt model. And last week, the rally hadn't made a lot of progress. On a scale of 0 to 100%. We were sitting around 7%. And the model encompasses many of the periods and signals that we've covered in recent weeks, including the DeMark 913 count seen here in May of 2022. And relative to the historical cases, one of the big questions in the present day was the concept of a Fed or policy pivot. Remember, we had a successful 913 in 2011, accompanied with a pivot from policymakers. Similar situation, 913 2016, with a pivot from the Fed chair. 2018 case was a little bit different, no 913, but soon after the market low, Chairman Powell pivoted. 2020 case, we have a 9 paired with a 13, March 23rd. Headline for March 23rd, Fed announces unlimited QE. And one of the reasons for developing this new special situation model was the fact that we were skeptical about a Fed pivot in the present day. And as we mentioned previously, ultimately, the market makes the decision on whether or not policymakers have pivoted in a meaningful way. And as we mentioned last week, if they have pivoted and the markets decide to put in a final low and rally and begin a new uptrend, we pretty much know, based on the way this model is built, pretty much know with 100% certainty if that happens as we walk forward, we will not be looking at scores this low. And one of the reasons why we want to keep an open mind about the possibility of a successful pivot is we do have numerous setup signals that are telling us to do so. Because historically, a 9 paired with a 13, and another signal that was nailed down on May 27th, the back-to-back-to-back 80% up days, historically, the returns on the other side of those setups have been very, very satisfying. These are all the back-to-back-to-back cases dating back to 1968, and you can see the S&P 500 performed extremely well, especially over longer periods of time. But as we mentioned last week, not every case was a walk in the park. The one-year maximum drawdown in the 1980 case, a little bit over 17%, maybe more concerning relative to what we know about the present day, the back-to-back-to-back signal that was nailed down or printed on January 2nd, 2009, was followed by an extremely painful drawdown over the next 66 calendar days, almost 28%. And in that case, that's an additional drawdown. The S&P 500 in the rearview mirror here had peaked way back in October of 2007. And you may remember when we looked at the cases that we thought were most similar to the present day, it really didn't change a whole lot. The average drawdown was similar, the median drawdown similar as well. The takeaway was that if good things were going to happen based on these historical cases, with this case here being the exception, January 2nd, 2009, if we experience similar drawdowns to the similar cases in the present day, it basically said the recent lows would most likely hold. Of course, the exception would be this case here, where a drawdown of that magnitude would be extremely painful from a hypothetical perspective. And remember, the model was created to help us discern between a failed rally attempt here. So this is a rally attempt, this is a high. In this case, it was followed by lower lows here, and a successful rally attempt where the low was in. And maybe more importantly, what we're trying to determine is not only is the low in, but is the market ready to start advancing? Or is there a high probability that we're getting ready to resume an uptrend? The low being in place and the market being ready to rally are two different things. So when we're building this type of model, we're trying to figure out what can we find that discerns the right side of the chart where the low was in and the market was ready to advance, And the left side of the chart over here, or the date of the signal here, was nailed down on January 2nd, 2009. That's your back-to-back-to-back 80% up day right here. The market was down the next day, rallied one more day, and then plummeted 27% into that March 9, 2009 low. So when we built this special situation model, we used periods up here that were tied to periods with 913s, back-to-back-to-back 80% up days on the NYSE, the signal that we covered last week, 95% of S&P 500 stocks advancing, and buys from corporate insiders that in the past, for the most part, from a probabilistic perspective, these signals have also been very, very helpful. Perfect? No. And ultimately, the purpose here is we're trying to discern between a case that could potentially fail and be followed by a significant and painful drawdown, and most of these cases that were successful and for the most part, especially looking out 2, 3, 4, and 5 years, really good things happen in the S&P 500 index. Given everything we know today, that we don't believe the Fed has pivoted in a meaningful way, and that sometimes even 913s that tend to be very, very helpful from a probability perspective turn out to be quote-unquote bad signals, and taking into account that it's not unusual to get very, very large counter-trend rallies within the context of a bear market that are eventually fully retraced, retracements within a downtrend. This is a counter-trend rally within the context of an existing downtrend, dot-com bust bear market. Similar situation here, financial crisis bear market, big counter-trend move, fully retraced. So we know from last week our score on June 2nd was 6.65%. If we fast forward to June 9th, as of the close on Thursday, 3.51%. So still not very impressive. Nothing in hand as of Thursday's close telling us that we want to redeploy any of our capital in a meaningful way. And here are some of the inputs used in this special situation model, the 8-day moving average in blue, all the way out to the 250-day moving average in teal. This was the look of the chart on June 2nd. And here's a look of the chart a week later on June 9th. And you can see we're below the 21-day moving average. 8-day moving average rolled over during the session on Thursday, and we had our first close below the blue 8-day here after Wednesday's session. Compare and contrast the look of the chart here, approximately 9 trading days after the signal, June 9th here, and then in the vicinity of my cursor up here, similar situation. This is after the signal in 1984. This up here really doesn't look anything like this down here. In this case, quickly, the 8-day moving average pops above all of the moving averages. As of June 9th, the 8-day was only able to clear the 21-day, and price closed below the 21-day on June 9th. None of this predicts the future, but we trade the chart in front of us. The chart in front of us as of June 9th, clearly in a downtrend, and we really don't have any significant improvement. In fact, thus far, this rally attempt here looks weaker than this rally attempt here. Is it possible that this chart is going to improve significantly after the inflation report on Friday, June 10th? Absolutely, positively, yes. That's why we take it day by day with an open mind. Now, we wanted to know in these 12 historical cases using the back-to-back-to-back 80% up days, 12 cases that featured a relatively wide variance in the maximum one-year drawdown, here nothing, here almost 28%. Taking this into account, as of Friday, June 10th, 2022, 9 trading days were in the books since the 80-80-80 signal was printed on May 27th, 2022. In those 12 80-80-80 historical cases that we just covered, what was the average and median CCM score 9 trading days after the signal date? The answer? Roughly 46% was the average here. The median, roughly 35%. Also might be helpful to know, in these cases here that we deemed most similar to the present day. What did the average and median score look like 9 trading days after the signal? The average, a little bit over 23% of the boxes were checked. The median, a hair under 15% of the boxes. How does that compare to the scores on June 9th and June 10th? We already covered the June 9th score, so we're really way behind schedule here. 3.51%, significantly less, walking out 9 trading days relative to the average of those 12 cases. Significantly less, really what it's telling you is a significantly weaker trend in the present day relative to the median case and the average case. And if we focus in on the smaller subset, the most similar cases, a date shown here on your screen, and we scored them walking forward approximately 9 trading days from the date of the signal, 23% and 14.4% relative to what we had as of Thursday's close of 3.51%. It doesn't mean we're dead in the water here. This number can pick up at any time. So for example, this is being recorded on Thursday evening, June 9th. On June 10th, if we had a massive rally and a favorable reaction to the employment report and our score jumped up to this level here, or between this level and this level here, that would be noteworthy. But down here, it's not noteworthy. In fact, out of these 12 cases here, only 2 of them had a score that looked as weak as the score that we have on June 9th. So we're at 3.51% on June 9th. The 1970 case was a little bit weaker at 1.38%. You can see the market still had a fairly significant drawdown relative to the signal date. But maybe more importantly, we're only at 5.75% in this case here, and this is the case that we want to avoid. And after that, your lowest score is closer to 11%. So the weak trend does keep this type of drawdown, or at least a lower low in the S&P 500, for now on the table. So as we know, many of these cases feature a significant bullish, favorable pivot from policymakers or central banks. That's significantly different relative to what we knew on May 17th and on May 19th. Fed Chairman Jay Powell, May 17th, restoring price stability is an unconditional need. It is something we have to do. So we're dealing with that different animal, and last week we covered a lot of the data that we're seeing is not particularly encouraging either. And we're in the Fed's quiet period now because we have a meeting coming up next week. So we don't have anything new from policymakers relative to the concerning statements that we covered last week. Here's one of the sets of moving averages used by the special situation model. They're relatively fast, at least for our time frame, the 8-day all the way out to the 138-day moving average. This is what a full-bore bullish looks like over here on the left side of the screen. We really don't have anything like that as of the close on June 9th. On Thursday, June 9th, the S&P 500 was down 97 points. I can't emphasize enough, that doesn't mean this low isn't the low. And it doesn't mean that the chart is not going to improve walking forward. Let's look at these 2 cases here and see what we can learn. This case was an 80-80-80 signal on July 9th, 2010. It was a little bit early in terms of the market being ready to rally. Then another one came soon thereafter on September 3rd, 2010. So we're taking these signal dates on the 80-80-80s, walking forward approximately 9 trading days. So we're looking at July 2010. This is the 8-day all the way out to the 138-day here. Let's compare and contrast this case here with the September case. And we can see conceptually, in both of these cases, the low is in. The difference is your risk reward is better here than it is here. And there are some subtle but discernible differences on this chart. Example, in this case, the 8-day moving average turns up and makes its way to the top of the moving average cluster in this area here. Now notice, for the most part, price is rejected up here. This is the 112-day simple moving average in silver or gray. Now notice when we get up here, something as simple as the 73-day moving average. See, when we're up here testing these moving averages, the 73-day moving average, the slope is clearly down. 60-day moving average, clearly down. Similar situation here. The 8-day turns up. The 8-day turns up over here, the vicinity of my cursor. And in both cases, the 8-day makes it up to the top of the cluster. The 8-day makes it up to the top of the cluster. But if you look at all of the moving averages here, example, 73, down when price is up here. Totally different story here. It's trying to turn up now. And what this is telling you is, while this may be nearing the end of this rally, the look of these moving averages here, relative to their weaker look here, tells us we have a higher probability of making it to the other side. Also noteworthy, here you never really get into any of this white space. Here you have 1, 2, 3, 4 closes into the white space. Subtle? Yes. Potentially significant? Yes. So it might be helpful to know, what was the score in this case where the low was in, but the market really wasn't ready to start pushing higher into this white space? The score on July 22nd, 2010 was 13.11%. Better than what we have as of Thursday, June 9th, but not overly impressive. But if we fast forward to the second signal in 2010 and then walk forward approximately 9 trading days, our score moves from 13.11% all the way to 51.86%. And that's relevant because now you're checking more than half of the boxes of what we're looking for. And now you're starting to look more like a low is in place rather than a low isn't in place. And the further you move above 50%, the higher the probability, and that is the key word here, the probability that this low back here will hold. So the look of some of these moving averages here, they're down, tells us that while the market may have bottomed, it still might not be ready just yet to move higher. Those are two different things, and the scores bear that out. And in the real world, in this case, the low was in place, and the market was much more apt and ready to rally here than it was here. This is a pretty significant drawdown from here to here. And remember, this special situation model is one small piece of the weight of the evidence. It's based on trends. And the most vulnerable thing about trend following is whipsaws. So the whipsaws that we've seen recently, looking back intraday, about 10 trading sessions or so, that's a fractal. That can happen on any time frame. That's why this is one of many tools that we'll be using, including the core model. Given the S&P 500 dropped 117 points on Friday, there's really no need to provide an update to this model. It's highly unlikely that it changed in any significant way. In fact, it's highly likely that it dropped a little bit. As we've covered, from a probability perspective, there's a lot to be concerned about. It's possible we're retesting the lows and they're going to hold. That's possible. The VIX was fairly tame on Friday. And everything that we've talked about in this week's video, as it is in every week's video, the commentary is based on the facts and charts that we have in hand. If the charts and data shift in a meaningful way, we have to reassess the probabilities. Inflation came in above expectations, still a problem. The Fed is still a different animal. Given inflation is extremely high, really anything could happen with the Fed. They could do an emergency rate increase on Monday, probably not likely, but it's possible. Or they could raise interest rates by 75 basis points on Wednesday. You have to be prepared for something that might be somewhat unexpected, and it's very, very difficult to gauge the market's reaction to something like that. The market ultimately wants the Fed to deal with inflation. So we can't assume if they hike by 75 basis points or 100 basis points that the market's going to drop like a stone. As always, we'll just see how the market reacts, take it day by day. Keeping in mind, under our approach, no forecasting, no extrapolation, no assumptions. Because the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.